Hey YouTube, it's Matthew Decker with Leveraged Wealth Management. Today, I'm starting a brand new series and we're calling it Takedown Thursday. Now, the reason that we've started this series is because for years, we've been getting bad indexed universal life policy designs, probably 10 to 20 every single week. And for the longest time, we've just kind of let those bad designs pile up in a folder on a hard drive somewhere and haven't really done much with it. And so we decided that there was so much information needed around indexed universal life insurance policies that every single week we were going to take out one of those bad designs from that folder on that random hard drive and we're going to talk about it. We're going to show you what's wrong with it and we're going to show you how to fix it. So this is our first Takedown Thursday, and today we're going to be diving into a Life of the Southwest policy that was designed poorly that we got about a year ago. We're going to show you what's wrong with it. We're going to show you how to fix it. So here we go. So the first thing that I notice when I look at this Life of the Southwest illustration here is that I see this PFA. Okay, so anytime I see something like this, I know right away that this was designed by somebody who's a member of a multi-level marketing organization, and it's probably going to be done wrong because 99 times out of 100, that's the case. Okay, so we got PFA, great. So this is the National Life Group / LSW policy. I've blocked out everybody's names just to keep it all anonymous so that we don't have to worry about that. And I've deleted some pages here just to kind of make it easier because I've got a couple things I want to point out. The first thing I noticed, okay, we've got a 34-year-old male preferred non-tobacco. We've got a face amount of 1.5 million, so a pretty big face amount. We've got a death benefit option set at level. Of course we do. Almost every single design we see from PFA, WFG, all those other multi-level marketing organizations, death benefit option level. We've got a $17,900 annual premium, and then we've got all these riders that are supposed to mean something, but all of them are pretty much standard. So right off the bat, I know that this is probably a poorly designed policy. Now, layer on top of that, this client came to us and said, hey, I asked for a maximum cash, maximum income policy design, and this is what I got. What do you think? And so because of that, because that's the backdrop, I know that this is done wrong right out of the gate. LSW does have all 3/4, I guess if you want to call it 4, chronic illness, terminal illness, critical illness riders, which is pretty cool. They do a good job of that. It's kind of their, it's the bell that they ring. It's the selling point of their whole product. But let's just kind of go through this one at a time. So when it comes to this policy in particular, there is something I want to point out, and that is around the loans. And so you'll notice here, what page is this? This is on page 11 of 35. So they're going to detail all the loans on this policy. So we've got withdrawals, we've got loans that come in variable, standard loans, and then we've got this participating fixed loan. So in general, I am not a fan of policies that force you into variable participating loans simply because most policies have uncapped variable loans. Now this one is capped. I believe it's capped at like 1% above the fixed rate, but the fixed rate can move. So essentially you have a variable here that you can't account for when it comes to generating income on the policy. Because of that, I'm in fan of participating fixed loans where you know exactly what you're going to get when you go, or what the loan rate's going to be when you go to take your money out of the policy. However, in this particular policy, and there are several policies like this, so you got to be careful. When you choose the participating fixed loan, they hide something in here. So let's just read it. Participating fixed loans are charged a fixed loan interest rate, which will be set at issue. That's all good. The current is 5%. That's fine. Requested loan amounts will be transferred. Ooh, okay, interesting. The requested loan amounts will be transferred from the various interest crediting strategies, in parentheses, my commentary, that you've chosen. So it's going to be transferred from the strategies that you've chosen into the index loan holding account. Any value in the index loan holding account will be swept to the indexed loan account. Okay, so what does all this mean? What it means is if you choose a fixed participating loan on this particular policy and several others, you no longer get to choose how your money is allocated. You do not get to choose the index that gets the credit. The company puts it into a specific index that they control, the caps and rates on that index separate from all the other indexes on the actual policy. So what does all that mean? It means if you choose their fixed participating loan rate, you're forced into one allocation. That one allocation can be changed apart from all the other allocations in the policy. I don't love that. Just pointing that out there, that's a freebie. There you go. The other thing that I want to focus in on here, this is a bad design. How do I know it's a bad design? $17,939 in premium, and yet our maximum non-mech premium is $44,500. $474. This contract is woefully underfunded if the goal is maximum cash. How can you say that the goal here is maximum cash if you're paying $17,900 and yet the maximum premium is $44,474? It's not even close to a maximum cash design. And why is it not close? Why did this get sold this way, or why did the agent position it this way? Because doing it this way generates more commission. And so they're incentivized to show this, even though it's not right for the client. I want to point out too that the caps on this policy are pretty low, which, that's just, it is what it is. But I wouldn't recommend this at this point in time. And then the last thing I want to touch on this contract before we have to kind of try to fix it and go a different route here. A lot of these policies now have these enhancer bonuses. And these enhancer bonuses, you'll see it here. They've got the enhancer, the plus, and the max. The enhancer doesn't have a cost, and you better believe that most people selling these policies are showing the bonuses that have a cost because it makes the numbers look better. So this is showing that enhancer max, which is the big one. The big one has a 3% cost every single year that is on top of all of your cost of insurance charges, your policy fees, your premium loads. An additional 3% asset-based charge for this bonus. And yet in these numbers, now this is an old design, they can no longer show it this way, but in this old design, they would show you a fixed rate of return. So let's say that they're showing a flat 6% every single year. Well, that 6% is paying out this enhancer max bonus, and it's only costing you 3%. What they're not showing you is the effect of getting a 0% return and eating that 3% cost. Because of that, I don't like these types of designs where they show these policies with these huge charges and don't show you the adverse effects of those big charges in the years when you get a 0% return. Okay, so, and here's how that enhancer max basically works out. But I have to rerun this policy because this does have that enhancer max bonus on there, and you can no longer show that on illustrations today. And so I have to rerun it and show you how this policy would work without that enhancer max, because I don't want to supercharge the fees without showing you the benefit of the bonus. And so what I've done is I've gone in here and I've reran this policy, $1.5 million death benefit. We've got the same $17,939, and all I really want to do is I just want to look at the cash in year 15, year 20, and maybe year 25, okay? So the first thing about this policy is you got a cash value of $0 in the first year. That pretty much tells you in almost every case that this is not a max funded contract. And let's look at the cash in year 15. So we stop paying premiums in year 15, $17,924, we've got $306 in cash. If we go out to year 20, we got $383 in cash. And let's look at like year 25 just to do that. So year 25, $484 in cash. So this is the policy redone without that enhancer max bonus because you can't show it anymore, but otherwise it's the exact same contract. Same premium going in, $1.5 million in death benefit. Everything else is the same, 34 male. We've got it. It's great. All right, so I want to show you how to fix this policy because this was obviously not sold by somebody who's a fiduciary. They are looking out for their own best interest, not the best interest of the client. So I want to show you what we would do if you sent us a policy like this. So let's go to the right design. So this is the one that we ran today that is done the right way. So we've got two things out of the gate, that you can look at here. So face amount $706,000. Death benefit option B increasing. What does that do? Well, we've basically cut our death benefit in half, which is going to cut the fees in half. By cutting the fees in half, you get better cash growth, you get better income projections, and it's a better policy for the life of the contract. The crediting is actually better. So we've got a $2,900 cash value in the first year versus a $0 cash value in the first year. If we go out to year 15, we've got $370 in cash. In year 15 on the bad design with the higher face amount, $306. 370 versus 306. If we go out to year 20, the bad design was at $383,000. The good design that we would have recommended, $493,000. That's $100,000 better for the client just by reducing the fees and the commission on this product. You can tell right out of the gate, this policy was not done by a CFP. It wasn't done by a fiduciary. It was probably done by a broker who's trying to max out their commission. Let's go to year 25, $658,000 in cash in year 25. In the bad policy design, year 25, $484,000 in cash. I mean, we're talking worlds different. This is exactly why if you see a policy like this and you see that the maximum premium, that 7-pay premium, is nowhere near the premium that you're actually paying on the contract, you can't move forward with that policy if your goal is maximum cash and income. You just can't. It's a bad policy, and you're working with somebody that either doesn't know what they're doing or they don't care. They're trying to max out their commission at your expense. And that's exactly why we're doing Takedown Thursday, because we probably have thousands of these examples just like this. Some are worse than this, that show an agent time and time again looking out for their own best interest instead of the best interest of you, the client. I'm just scrolling here because I want to show you the maximum premium on the good design, just so that you can see where to find it, so that you know that it's done the right way. So here it is here. We got our max non-mech premium, $20,943. Our guideline level premium, $17,939. How do you know that this was done the right way? You have to look at these two metrics, guideline level, max non-mech. Those two premiums need to be close together, and they need to be close to the premium that you're paying. That's how you know that a policy is structured the right way. So we've got about a $2,500, well, it's about a $3,000 gap there between guideline level and max non-mech, and you're paying the guideline level premium, so you know that this policy is done the right way, versus the bad design. If we go back to the bad design here, we had our max premium, I think, at $44,000. Yeah, max premium at $44,000, guideline level premium at $17,000. We're worlds apart in terms of those two premium numbers, and you're paying the guideline level. You know that this isn't maximum funded. So the point of this video, if you see a policy like this, where you kind of get the sinking suspicion that it is not designed in your best interest, you cannot move forward with that policy. You probably need to talk to somebody else, whether it's us, we'd love to help you out, or somebody else, don't really care. Number one, I'd recommend that you start with a fiduciary. So I'm a CFP, my partner's a CFP. We're fiduciaries. We have to be. Not only are we fiduciaries in the securities world, we're fiduciaries in the fixed world. This is life insurance. It's a fixed product. We have to act in our client's best interest. If you're working with a broker or an agent that's not a CFP, they're not a fiduciary. And so you can't be certain that they're actually working in your best interest unless you want to spend, 5 to 10 hours pouring through all these contracts, looking at 5 to 6 different options and making sure that they're doing what's right for you. You have to double check their work. How's that fair? It's not fair, because they're the ones that are supposed to be the experts. Well, we consider ourselves experts. So if you have a bad policy that you think that you're looking at, I would encourage you to send it to us. You can send it to info@leveragedwm.com, or you can go to our website, leveragedwm.com. You can find the Contact Us page. You can reach us that way. But this has been our very first Takedown Thursday. Much more to come. I look forward to seeing you next week, where we look at another bad policy design. Take care. See you later.